So first question that came in live came in from Mike. And he says, if you wanted to make daily, small, non-directional trades, either long volatility or short volatility, what would you look at doing and how would you use PowerOptions to find and track them? Okay, so Mike, 8 months ago, 6 months ago, maybe, we had a conversation, not you and I, of course, Mike, but we had a conversation during the webinar about the 0 day to expiration positions. In fact, if you go to our YouTube channel and you use our little magnifying glass search on our channel and just look for 0 DTE, you can quickly find some of the different discussions that we've had, risks and benefits of 0 day to expiration, poor man's covered calls. Setting up a 0 day to day expiration search, introduction to 0 TTE trades, so on and so forth. Spread discussion, 0 days expiration condors, setting up a spread. I'm looking for the one that was just a little while ago and I'm not seeing it. Maybe I've passed it already. Oh yeah, 4 months ago, introduction, but it went a little bit more in depth. Now, you may not be thinking specifically about the 0 day to expiration spreads, okay? What I mean by that, what is the 0 day to expiration spreads? As you all know now, there are a couple indexes and ETFs that offered daily trading. And there's a lot of gurus out there that talk about the 0 day to expiration spreads. Well, I can't back test that, Mike. What was coming from with the webinar discussion we had that 4 months ago or so. You can't back test that because, of course, our back testing is done at the end of day. It's not looking at intraday prices, which you have to pay attention to when you're following a 0 day to expiration trade. At the same time, what I tried to do is a few weeks of testing that, opening a trade, and I would open the trade at about 10:15, 10:20 in the morning. Why so late? Because you don't want to fight that first hour, that first half hour where everything's digesting the news and bouncing back and forth. Do I miss out on some volatility there? Yes. Did I miss out on guessing, ooh, it looks like the market's dropping today. Let me do a bearish spread or a directional spread. And then, no, we were okay with that. And then the market comes back up. So my 0 day to expiration spread was a complete wash. I had to close it for a loss. And when I did that for about 3 weeks, as I mentioned, opening a position at 10:15, closing it before the end, with just the 0 day to expiration positions, the daily options, I should say, the daily options, the success rate was only about 65%. I was looking for probabilities at the time that were still in the 78, 82, 85% range. But the success rate wasn't there to be successful long term. If you had to roll a position, you'd have to roll it almost 4 or 5 weeks out in time. Now, you may be saying to yourself, well, that might not be what I'm specifically talking about. I'm not really talking about 0 day to expirations. They can be, and you just said that, and I knew that's where you're going. I want to trade a stock that I'm following. It doesn't offer daily options. Maybe it offers weekly options. How can I do something on a daily basis to hedge it? All right. Now, I can't number these out directly, but the first thing I would say, Mike, is number one, you have to have an overall direction for the market. And you're saying, if you're going long vol, short vol, what would you look at doing and how would you use PowerOptions to find and track them? Okay. So if I want to make daily trades to try to, what's the term? It's not scrape. People used another term for it back in the day. But, I kind of just want to get a little bit of premium day by day. Naturally, the only way to do that is to be selling something, in my opinion. You can be buying something, but you need a significant move on that day. And once you turn on the market at 9:30, 9:35, like I said, there have been a lot of days recently where the market's gone negative. And then 20 minutes later, it just digests it and says, no, we're okay with this. We started down 0.5, 0.8%. It looked like a down day. And then next thing you know, we're up 0.1%. So I would try to gauge what your direction is on the market. And I'm just off the top of my head, I'm going to suggest 2 things for you. Number one, we're going to look at a calendar call. We're going to look at a diagonal spread. All right, we're going to look for positions that do have a shorter term expiration. So hopefully that time decay can work in your favor, Mike. But at the same time, instead of doing a true, what I'd call diagonal spread, buying a leap or poor man's covered call, buying a leap call and selling 2 weeks out or selling a month out against it, we're going to buy something that's 2 or 3 months out in time. We're going to sell a weekly call against it. And then we're going to try to scrape some of that premium off on a daily basis. And if we don't get any gain on that short option in the daily run, then we'll leave it open for the next day. See if we get a little bit more time decay. So it doesn't have to be every day, but you've got some premium up front. What is that premium doing? It's knocking down the cost basis of the position. If you're bullish, you're going to look at calendar calls. If you're bearish, you're going to look at calendar puts. What would I try to look for in this scenario? Well, I try to just use the search tool itself. And we're just going to go into one of the default calendar spread searches. Which one do I have? Initial values. That's a good starting point. This is looking at the nearest expiration, not the nearest expiration, but the nearest expiration that's beyond 20 days out in time, compared to a leap option that's at least 250 to 650 days out in time. There's some specific criteria here that are listed. You know, net debit can't be more than $15. I'll explain the downside protection. Of course, the peak return, the max return at the peak, at least 4%. Call that I'm selling, it's going to be near term, is at least 0% out of the money. And the call that we're buying is going to be at least 5% in the money, and so on and so forth. And then these we're going to discuss too, because we're going to keep most of those. We're going to change some basic stock criteria and maybe look for some things that are a little bit more of a pronounced trend long term. But what is the first thing I said I wanted to do? I want to look for something that expires maybe 8, because we're searching on Friday, of course. When you're searching on Monday, Mike, you might want to, you could lower this down to 6 to 12 days, but we're going to go 8 to 16 days out in time. So I'm going to look for 1 week to 2 week out short premium positions. What did I say? 2 to 3 months? Let's go 60 days out in time, and I'm probably going to go up to 100. Okay. Now let's leave that alone for now. Let's just talk about what kind of stocks we want. I'm deciding I'm bullish. If I was bearish, we'd look for the opposite of what the fundamentals and technicals we're going to talk about right now. But in the bullish situation, yeah, I want to see stocks that have a good earnings per share growth, relative PE ratio. I'm going to avoid earnings between now and expiration because I don't want any sudden hiccups with what you're looking to do. You're talking about scraping daily premium rather than necessarily looking for something for long term. Okay? All right. Now, I'm going to go into the technicals. And, you know, if you wanted to put anything in, minimum average stock volume or anything like that, specifically what I'm going to look for is stocks where the SMA 20 is greater than the SMA 50. I'm looking at shorter term. Actually, I'm going to do something else. I'm going to look for stock in SMA 20 above the SMA 50. Okay, and I'm going to look for stocks. This is bullish. I'm going to look for stocks that have had a MACD cross that have been at least 3 days. They've had a positive MACD crossover for at least 3 days, and I want the MACD line itself to be positive. I'm not too concerned if the signal line is negative. If you need me to explain that a little bit more, but there's other help videos and discussions on that as well. So just some basic technicals. You can use the RSI if you want as well. The fundamentals we talked about. Now back to the options for some of the more complex things. We're using shorter term. So this is a calendar spread. I'm going to buy a 2 to 3 month out call. I want the net debit to be maybe 9. Okay, I don't want to pay more than $9 between what I'm paying for that 2 to 3 month out call and what I'm collecting. Downside protection. Now, this is defined as the option premium we're collecting divided by the cost of the option we're buying. So I want at least some protection. I probably want it at least to be 8 or 10%. I'm going to try 8% in this case. So that means the premium I'm selling is at least 8% or more of the price of the call that I'm buying far out in time. Max return, I'm going to leave at the 4. As I said, range out of the money. Yeah, we're going to put this up to percent out of the money, 1 to 3, for example. Oh, no, sorry, folks. 1 to 3. 1 to 2 weeks out, 1 to 4. And I am going to be 5% in the money. A little bit of the option bid. Hey, option volume today, I want to see contracts that had some activity. And, I could put a basic open interest, say, of 10, 15, or 20. Okay? I'm going to leave my bid-ask spread things here. Now, this is going to be important. I am buying a call 2 to 3 months out to sort of simulate stock ownership. Not buying the stock. I'm buying an option, but I want it to be in the money. I've forced it to already be 5% in the money, but I'm going to want this delta to be at least 0.6 or more of the option that I'm buying. Now, I want my delta ratio to be greater than 2. Why is this important? This is the delta of the buy option divided by the delta of the sell option, meaning if the stock does go in my direction, I want the call that I bought to see twice as much gain in the call that I sold, working in my favor. Now, I might not be seeing a decay to try to scrape as you're talking about, You might want to look for a more neutral position. And I'm also very important on the calendar spreads, uses debit to strike difference ratio of less than 1. What does this mean? This is the net debit that you're paying into the position divided by the difference in strike prices. I always want that to be less than 1 because I always want to be paying less than the difference. If I have a 10 strike difference on a calendar spread, I'm selling a 100 strike and buying a 90, my debit has to be less than $10. If it's above $10 due to the price of the options, volatility of the 2 to 3 month out calls that we're going to look at here, because earnings might be coming up, but we sort of tried to negate that, well then, we're in a position where we can now, excuse me, even if we get a sign the stock surprises us and jumps up, not what you're looking to do. You're looking for more of a neutral to try to scrape premium on a regular basis, daily basis. Okay, so if it does spring up suddenly and I get assigned early in a short call, my broker is going to exercise the long call to deliver the short. If the debit's greater than that when they do the automatic assignment, I lose. I lose money. All right, so let's go ahead and submit that. All right, so we've got AstraZeneca stocks at stocks at $71.99, selling the 14-day out February 73 call, buying in April 69 days out in time, 67.5 for $535, a 13% downside protection. Peak tent return at the max of the profit zone, max return is 32.3%. That's the best case scenario. Now, most of these are close to the money, but what do you know, Mike, about options? Right? The options that are at the money will typically see the highest time decay if the stock stagnates in your favor. Okay? But again, that puts you in that probability range of the stock moving above the strike price and getting assigned. Here I'm forcing it to be a little bit out of the money because I want to see some good time decay on this position. What that is for you, I don't know. If that's 10%, if that's 15%, if that's 20%, I'm not really sure. Okay, but that's a way to do it. So let's just go ahead and take a look at the chart here. The profit and loss chart, excuse me. I want to talk about some of the features that we talked about. All right, so here's the position, $71.99. We're selling the security for 78 cents, roughly at midpoint, and we're buying this at 530. So we have 452 invested in the position. Max profit. Now, and anytime we're talking about a calendar, max profit is the theoretical return, the best we can do. What this tool is doing, what any tool is doing, your broker's tool, Tasty Trade, Thinkorswim, whatever, we're calculating what is the theoretical price of your April option if your stock is trading right at 73, the strike price of your sold option on February 21st. That's how it has to be done. If certain things such as implied volatility change, these are pretty low, so I don't think we have to worry about too big of a shift there. But if those implied volatilities drop, your return would be lower. Now, what am I looking to do? Let's say that I apologize, of course, on, let's see, here we are at the 10th, yeah. So on Monday, if the stock remains at $71.99, we sold this option for 78 cents, okay, we'd expect it to be about 66 cents. We made 12 cents on a 78 premium. So you kind of generated, a little bit of premium. And, not necessarily this wouldn't be a gain, it's because of the applied volatility, but in any case, would that work? And then a few days later, if it stays at the same price or around the same price, you've made about 27, about a third of the premium that you collected in 2 days. The reason I'm concerned about this approach, Mike, is that number one, it's going to take a lot of time to watch this position. You can set it, you can track it in PowerOptions, but you can set alerts in PowerOptions, but number one, the time constraint on this to watch the market, watch your trades on a daily basis is going to require a lot of time. Number two, planning. This is how I set up the search exactly as I mentioned. We'll put it in the portfolio and I'll give you some ideas on the alerts here. But the planning on this is going to have to be fairly thorough. What do I mean by that? You're selling something that expires in 7 or 14 days. The reason why we saw the 14-day out options the most is because they offer the best premium and we were sorting by highest return to lowest on the few stocks that matched our criteria. Okay. Now, by the planning, I mean, what is your target goal per day? Is it a monetary amount? 12, 15, 20 cents. Is it a percentage amount of the short option? 12, 15, or 20%. What do you do if it exceeds 10 or 15%, meaning the stock moves up and the short call increases in value? Your long call should be increasing more. That's one of the reasons why I use this structure rather than something such as an Iron Condor, because you're sitting here and you're saying, oh, if everything stays the same, my bear call credit spread is decaying, my bull put credit spread is decaying, I'm just getting time decay and it's working in my favor. Stocks have not been staying the same recently. You know, we jump up in the morning, we come back down. We jump down in the morning, we come back up. So there's always fluctuation here. And in this kind of setup with an Iron Condor, okay, I'll do the Iron Condor correctly. In this structure with the Iron Condor, if this one is gaining for your side because the stock moved up, your bull put's gaining, your bear call's losing. You're at a wash here a little bit. You're not scalping that premium. If you're bullish long-term on the market and this stock starts to move up, you should be making more on this long call than you're losing on this short call. And if it fades a little bit, you should be seeing a reasonable amount of time decay here on your out of the money call, this 73 strike, where the 67.5 in the money and farther out in time is going to see some decline. Well, let's look at that real quick. You are going to see some decline, but it should be roughly countered with this option moving away from the at the money bell curve. You know, stocks at 72, we're selling the 73, and we bought the 67.5. So if we fall slightly here, this is now further out of the money and should be decaying more, whereas this one should be retaining still some of its time value, but you're going to lose a little bit of intrinsic naturally. So it's a trade-off there too. But then what can you do? Cover this and then resell a 72 strike the next day with the stock down at 70. You're trying to do that daily thing. Time, but planning. You've got to have a great trading plan to do this. 3, in addition to the trading plan, what we're talking about, the planning, is management. And I don't just mean management as part of the trading plan. I mean, you're going to be doing frequent management on these positions, Mike. Okay? You're going to be rolling down, closing out, waiting the next day to see which call you want to sell or which put you want to sell if you're in the calendar put spread. That's going to be a lot. Now, number 4, related to the planning, of course, we talked about it, alerts and reacting to the alerts. Now, of course, on PowerOptions, let's clear this all out very quickly, all our drawings out real quick. And I'm going to add to portfolio. We're going to add it to our February 7th, 2025. There's a couple discussions we might get to once we get through our live questions. We're just going to enter this little calendar spread here. Oh, sorry about that, folks. Let me go back up here. There we go. All right. So here's that AstraZeneca calendar spread that we've entered. I've also got a covered call and a long collar here entered from some questions that came in via email this week. Now, as you know, you can set the alerts on PowerOptions. Under the alerts column, just click view. And you can set it against either leg. You know, what is the lower price limit for the stock? I want to be notified if this stock drops below 70. Okay, because now I'm getting closer and closer to my long strike, but that's also going to mean that short strike's easier to buy back. The upper limit, we sold the 73. I would probably want to be notified if this hits 73.50, because although I'm probably gaining more on this option than I'm losing on this option, it is telling me that I probably want to roll up to the 74 or 75, or just close the both legs if I'm at a profit. But again, there's the question, part of the planning. What is your target profit if that happens in this scenario? You could set a delta limit as well, the time value. That when we set something on the short option, when the ask time value reaches a certain level, you know what the time value was when you opened it, you'd research that for this strategy, and then you'd put that in as well. In the money range, I don't want to be notified if it's more than 0.8% in the money, for example, when I potentially look to roll the position. And then position change, increase or decrease. Okay, so we would just set some of those alerts. Those are some alerts I might set based on what your targets are going to be. These are not the targets I would use necessarily. I'm just setting the alerts in that fashion. Now, once the alert's triggered, you'll see it here. You'll receive an email. You can always go to the alerts overview to see if any of the positions that you have hit alerts on that as well. Okay, I'm going to save this real quick. And we're going to call this Daily Cal Call from February 7th. Now, the reason why I'm doing this, I know it's going to be a little bit slow, and I apologize for that. This always happens, of course. But yeah, during the Friday discussions, what we're doing right now is we're uploading all of the historical data, the end-of-day data, into our fields. The reason why I wanted to save that is that here on the trial, I do have 3 months of access to the back test. Now that we've saved my search, I'm going to go to back test. I want to go to Smart History Excel. We're going to do a search in calendar call spreads. We're going to go to January, what was it, 3rd? January 4th? January 2nd, start of the new year. And we're going to go to Daily Cal Call. Now we're going to go ahead and submit that search. Might take us a moment or two to find the results, as I mentioned, and it's because everything is uploading into the historical table at this time. Let's see, there we go. Okay, no positions matched. Let's go mid-month. Let's go another week out. The reason why is maybe that my time frames from 8 to 16 days weren't set right. So let me go to the Friday of that week, which would have been the 3rd, or we can go to the Monday. I'm going to go Monday the 6th. Now, I didn't use the checkbox for one result as security, so we are seeing 3 different positions. 11 days out in time, against 74 days for the March expiration. Range, resources, equitable resources. Let's calculate the group results. And so it's going to calculate to the end here of that first 11-day cycle, but we're going to delve deeper into that here, looking at this as well. All right, now, over that, sorry folks, over that 11-day time period, we sold the 38 call on RRC. Stock ended at 41, so we were deep in the money, but the liquidation value was a 23% return. The max peak return was 31.9%. So we're on that back slope of the calendar spread. Sorry, folks. Whereas the stock continued to move up above the strike, we gave a little bit back. Okay, so that's what's happened there. 30 and 25 were the other ones. Yeah, so we got about the 25% return here at 49. Stock ended at 52.96. We would have only done one of these. Probably going with the one with the lower net debit. So we probably would have done the 44 to 49. But if you want to be more conservative, you would have gone with the higher delta ratio of the March 42 to the January 49 strike. RRC, though, now that I have my results of how that worked, and again, I must note, of course, that even though we just did this on the fly, past results are no guarantee of any future performance. But let's go to the More Information button, and let's go to Analyze Position here in the Historical Tools. Why am I doing this? The Analyze Position, which sometimes takes a little bit longer to load, is going to give us a day-by-day breakdown of the return on this position. So you might have closed it, at the end of day. You might have closed it close to the end of day. We're going to see what the daily profit potentially was on each day, what the value of the short was, what the value of the long was. Did we make profit on a daily basis in this scenario? Naturally, it's doing a lot of computing to go back through the history, to go back through all the options tables. It's usually pretty quick, but again, we're interacting with all the tables right now. So, short call, here's our total return here in red. And right off the bat, it looks like we did start making money. The first day, though, we didn't have a profit. Zero change. We did start to make money as it went up. This was profitable the entire time, this particular position. Short call midpoint, however, was increasing. We got 43 cents for it. I'm sorry, 42 cents originally. It's 33 cents at midpoint on the first day on the 7th. But then the midpoint moved up as the stock kept going. So I did look for bullish stocks because inherently this is a bullish setup, not necessarily neutral. It's neutral to bullish, I should say. We do want the short premium. Maybe if I went a little bit out of the money, it would have been fine. But we saw that this stock really moved up, ramped up as high as 330 in these positions. The first day, it did give you the premium decay you wanted. You got 42 cents for it, 43 cents, and it dropped about 10 cents to 33, scalping 10 cents. But if I scalped 10 cents every day on this trade for 11 days, the maximum profit would have been $1.10. total cost at the end was $1.18. We did better actually holding the position because it is more directional. I'll admit that it would benefit from that longer term trading. But you know, we originally paid $368 to get in. The net value is $453. Okay, so it's not $118. I'm sorry. So, but you didn't see the 10-cent decay. That's what's hard about trying to scalp these daily positions. You have to be right on the direction every day. I don't think these are the market conditions to try to guess every day. Personally, Mike, that's my personal opinion. I'm not saying that you should use zero data expirations either. And I'm not saying, as we mentioned before, when we were looking at that custom spread, that the Iron Condor is a good position, or a short strangle, or a short straddle, where you're negative a call, a naked call, and a naked put. You're trying to play a volatility move, saying, oh, I think the volatility is going to fall after today's jump, so on Monday it's going to fall. I'm going to sell something right here, right at the money. There's too much inherent risk to do this, even if you're watching it a daily basis. You have no idea what's going to happen the next day. You have no idea where the market's going to open in these conditions. The other thing I should have mentioned, in addition to time constraints that this strategy of daily scalping is going to take for you, in addition to intense planning of when and how and what targets are you looking for to try to do daily scalp on this position or on any of these positions, it has to be intense and you have to follow it. 3, you've got to have your alerts set cleanly for both legs, as well as any changes in the market. And you're going to be hearing a lot of bells and whistles going off on a consistent basis. And then, of course, number 4, the time of management and actively managing these trades. I know that goes into the time constraints for the position, but it's not just about watching it. It's about paying attention to the management rules you set in the planning and saying, oh, there was a little bump here today at 2 o'clock. Does that mean it's going to continue down and I should get out now? I'm not quite at my daily goal, so maybe I should do that, do this. That's where it's going to be hard. And number 5, sorry, I'm going to draw through my little Iron Condor wedge here. Number 5, you are going to have to pay very close attention to any and all upcoming economic reports. I don't know how often you pay attention to them now, Mike, but even today, things such as the jobs report, anytime a CPI comes out, anytime any of those inflation reports come out during the month or the week, you're going to have to pay attention to earnings. If I went into AstraZeneca, I removed the earnings between now and expiration for that calendar search. But what I'm also going to have to do, Mike, is I'm going to have to pay attention to the earnings reports of any of the stocks that are in their secondary industry or competitors. Because if another pharmaceutical like AstraZeneca, big pharmaceutical, let's say Boston Scientific, for example, or something more aligned with AstraZeneca, has earnings in the next 2 days, their earnings come out and they're negative, well, the stock could fall. Now, that would work for your daily scalping, but then you're going to be losing money on that long call, which is really your investment into this trade. You're not in the stock as well. Daily scalping is very difficult. The zero data expiration trades was very difficult. I did not see it outperform what I was currently doing by holding positions for a longer term, 7, 8, 14 days, for example, when I ran those searches, when I was actively trading them in the month of September and October, and get in, open the trades, maybe at 9:45 to 10:15, somewhere in that time frame, and then try to close it by the end of the day. And like I said, 65, 66% success rate. But with any kind of leverage spread, whether it was a bullish spread, a bearish spread, or an Iron Condor spread, in that case, yeah, it needs a 75, 78, 80, 82% success rate to be successful and profitable long term, and I was not getting it. Okay, but maybe I wasn't going far enough out of the money. Maybe I wasn't putting the structure in correctly. I tried different things using delta, but I focus on probability more. But again, that's my thoughts on this, Mike. That's how I would do it. I would go calendar spread, as I mentioned. I would go, sorry, I'm not in the search anymore. I got out of that. Let's go back here to the calendar call search. I would look for maybe something that's 2 to 3 months out in time, maybe 60 to 95 days out in time, and shorter term, a week, 1 week out or 2 week out position there in that case, and then see where we go at that point. And I'd use some of those other criteria, because in this case, I'd be bullish. I'm saying I'm bullish long-term, bullish to neutral long-term. If it's bearish to neutral long-term, I do the same setup, but with the opposite fundamental and technical criteria